Now friends, we have more provisions to complete in this particular chapter. The next few sections like 44DA, then we have 44C, then we have first proviso to section 48, then chapter 12A, 115 CD, EF, GHI, etc. are not presumptive provisions. We can call it as administrative provisions. These are not presumptive provisions, but these are supporting provisions for computing certain types of income of a non-resident. Are you with me? So to start with section 44DA, that is special provision for computing income by way of royalty, etc. in the case of a non-resident. Say, listen friends, if you are a non-resident and you are in receipt of say royalty, or fees for technical services, while computing the total income, you have to be careful about certain things. You have to follow or satisfy certain things. What all are the things? That's what we are about to discuss under 44DA. So if you are a non-resident having an income of royalty or fees for technical services, while computing that royalty or while computing that fees for technical services, you have to be careful. There are certain things that you have to be careful, and which all are those things? That's what we are about to discuss right now. Are you all listening? Let's understand what exactly are the points. Listen. Yeah. So starting with the first sentence, that is, this provision is for taxing royalty or FTS in the hands of eligible assessee. For 44DA to come into picture, the NR have to be an eligible NR. The NR, non-resident, have to be what? Eligible non-resident. Let's understand who all are the eligible non-residents. So you have to satisfy all these three conditions, then you will become what? An eligible assessee. If you satisfy all the three boxes, you will become what? An eligible assessee. Let's understand condition number 1. What is that? NR having made an agreement with an Indian company or government after 31st March 2003. If you want to become an eligible assessee, then you have to be a non-resident, and you should have an agreement with either an Indian company or with the central government. That too, the agreement have to be framed on or after 31st March 2003, not 23, 2003. Second condition, the non-resident should have a PE. What is PE? Permanent establishment. We will study it in DTAA chapter. Permanent establishment. Permanent establishment for the time being, imagine it as a branch in India. Are you with me? Whenever I say permanent establishment, for the time being, understand it as a branch in India. So the non-resident should have a branch or a fixed place of profession in India. That non-resident who is earning that royalty or FTS should have a branch in India. That's what they are saying as point number 2. Okay, then what is point number 3? The royalty or FTS received should be connected with such branch. That royalty or FTS should be connected with that particular branch. If all the three conditions are satisfied, then we can call you as an eligible assessee. After completing the entire theory, I'll give you an example to make you understand what exactly is 44DA. So until we complete the theory, you have to be a little bit patient. Listen, 3 things. Which are the 3 things? The NR should have an agreement with either Indian company or with the central government, that too after 31st March 2003. The NR should have a branch in India or a fixed place of profession in India. Number 3, that royalty income or FTS income should be connected with that branch in India. If all the 3 conditions are satisfied, then what is the speciality? What is the speciality? Royalty and FTS under this section is taxed at normal rates under the Act. We don't have any flat rates. While computing the total income, don't apply any flat rates. We don't have any flat rates under 44DA. It is taxed as per the normal rates. Then why should there be a 44DA? Then what is the objective of 44DA? Next paragraph is basically the 44DA. This is what 44DA is all about. However, while computing income, the following expenses are not allowed as deduction. So if you ask me to explain 44DA in a layman's language, what I will say is 44DA provides for a restriction while for claiming certain expenses. while computing royalty and FTS income. Are you with me? When you compute royalty and FTS income, certain expenses you cannot claim. Which all are the expenses? That is what 44DA is all about. For whom it is applicable, that's why this chart is all about. Are you with me? So let's understand which all are the restrictions. Restriction number 1. The expenditure which is not wholly and exclusively incurred for the business of such permanent establishment in India. So to make you understand this, let's start with an example now. Now let's deal with an example. Listen. Say there is Microsoft. Okay. Again, I'm giving you a disclaimer. This example has no connection with any of the activity done by Microsoft. This is only to make you understand the concept. Don't take this example seriously. Okay. Microsoft is, you all know, it's actually a company from US. Microsoft does have a branch in, does have a subsidiary in India. Microsoft India is there and they have offices also. Okay. Forget about all those things. Say Microsoft have a branch in India. Not subsidiary, branch in India. And the Microsoft and the central government have entered into an agreement. The Microsoft, or we can say the branch, the Microsoft and the central government have entered an agreement, say in the year 2013-14, and according to the agreement, the Indian branch will provide certain technical services. Certain technical services to central government. Are you all with me? If they are providing technical services, then the central government should pay what? Fees for technical services. Fees for technical services to branch in India. Are you with me? Now, let's see whether this fees for technical services is actually an income for that branch in India. Now we are checking whether this branch is supposed to apply section 44DA while computing this FTS. For that, what was the first condition? Do you remember the first condition for applying 44DA? There should be an agreement with the central government, and that agreement should be signed on or after 31st March 2003. As you all know, there is an agreement, and this 13-14 is after 2003. First condition is okay. What is second condition? That non-resident should have a branch, permanent establishment in India. He does have a branch in India, and this can be called as a permanent establishment. Branch is always a PE. Branch is always a permanent establishment. And what is the third condition? There should be branch, and the tech services should be effectively connected with the branch. And here we do have a branch, and the tech services are connected with the branch, and the branch is providing the tech services and branch is earning the FTS, and hence what we can say is this fees for technical services is connected with the branch. So all the three conditions are satisfied. Yes or no? Now, if all the three conditions are satisfied, you tell me whether government of India can tax Microsoft USA. No, the government of India can only tax those profits made by the branch in India. Even though the branch is an extended operation of head office, Indian government can only tax the profits of the branch, not their global profits. Actually, branch and the head office is only one. But for the purpose of computing income tax, we have to bifurcate, because we can only tax the profit of branch, not that entire Microsoft. Are you with me? So what department say? When the branch in India is computing their total income, they are not supposed to claim certain expenses as a deduction. What is number one? We'll go to the theory and come back to the example. What was number one, or what is number one? Any expenditure which is not wholly and exclusively incurred for the business of such permanent establishment. That simply means only those expenses which are exclusively incurred for the branch can be claimed as a deduction from the FTS. Are you with me? Don't come and claim any common expenses, overheads, etc. of your head office with the profits of this branch. Not possible. You can only charge what? Exclusive expenditure. Exclusive expenditure for the administration of this branch alone can be claimed as a deduction from the FTS. Are you with me? So all those expenses which are not exclusively incurred for the branch is not allowed as a deduction. That is the first restriction. Read this. However, while computing income, the following expenses are not allowed as deduction. Number one, what is that? Any expenditure which is not wholly and exclusively incurred for the business of such permanent establishment in India. Whatever expenditure which is not exclusively incurred for that branch, don't come and ask for deduction, you will not get it. Second one, amount paid by the permanent establishment to its head office or to any of its other offices. What do you mean by that? Say every year branch is paying, say, support fees to the head office. Every year branch is paying what? Support fees to the head office, because head office only developed that particular service. The branch is only providing it. So head office, branch is charging what? Branch is paying a support fees to the head office. Income tax department say it is only an internal payment. This is basically an internal payment. Since we can tax only the branch, we are saying that this payment cannot be allowed as a deduction of the branch. If we allow it as a deduction, then what branch will do? 99% of the profit branch will say that support fee. And our profit margin is only 1% ma. They will say like that, yes or no? That is not possible. So whatever payments given by the branch to its head office, fully disallowed. However, there is something in the bracket. What is that? Otherwise than towards reimbursement of actual expenses. What is this otherwise than by way of reimbursement of actual expenses? Imagine a situation, say the head office is actually sitting in a rented premises. Head office is actually, not head office, branch in India is sitting in a rented premises. Are you with me? Say the head office normally pays the rent. Head office normally pays the rent and branch reimburses this rent. Branch is reimbursing this rent to the head office. In this case, we can say this is actually a payment given by the branch to the head office, but it is actually a reimbursement of actual expense. What is reimbursement of actual expense? Initially, the head office only paid that particular rent. Now the branch is reimbursing that particular expenditure to the head office. This is allowed as deduction because this is an exclusive expenditure of branch. Initially, even though it is paid by the head office, the branch is now reimbursing it. That is allowed as a deduction. That's why they are saying otherwise than towards reimbursement of actual expenses. Are you all here? Two things, two restrictions. Only those exclusive expenditure which are incurred for the purpose of or for the conduct of business of the branch is only allowed as deduction. That is number one. Number two, whatever payment given by the branch to the head office, fully disallowed. If that payment is a reimbursement of actual expenses, no problem, you can claim it as a deduction. Are you all here? Are you all here? So be careful. 44DA applies to a NR only if he has an agreement with central government or agreement with an Indian company. That agreement is framed after 31st March 2003. Second one, he should have a permanent establishment in India. Third one, that royalty or FTA should be connected with the branch in India. If all these three conditions are satisfied, royalty is taxed as per the normal slab rates. Depends upon the legal status of that NR. If he's an individual, slab. If he's a foreign company, 35%, whatever it is. However, while computing that royalty or FTS income, you are not supposed to claim deduction for two types of expenditure. Number one, non-exclusive expenditure. Number two, payment given by the branch to the head office. Are you with me? But in exam, they may mix up the scenario. Okay, what if that Microsoft is providing? What if Microsoft is directly providing this tech services from USA to central government? Then 44DA is not applicable. Why? Because that FTS is not connected with the branch in India. Or what if there is agreement is before 31st March 2003? On or before 31st March 2003. In that case also, 44DA not applicable because second condition is the agreement should be after 31st March 2003. What if there is no branch for Microsoft in India? That case also 44DA is not applicable. Are you with me? If 44DA is not applicable, then how do you tax this royalty and FTS? For that, there is another table created by me. what the table says is royalty or FTS income received by non-resident or a foreign company shall be taxable as follows. This is actually applicable for your exam. This is only for the exam. It is consider it as an exam tip. Okay, consider it as an exam tip. Whenever there is a royalty or FTS, first you need to think about the possibility of 44DA. You need to check the possibility of 44DA. If conditions as above are satisfied, that means the three conditions in the box. If it is satisfied, then tax that normal rates without claiming expenses as above as a deduction. Then you tax it under normal rate only. Don't charge those two expenses as a deduction. Are you with me? Then, what is point number 2 or box number 2? If 44DA is not applicable, then what? Then check about the possibility of 115A. If not covered under 44DA and there should be an agreement entered into between the assessee and the individual company or with the central government. Section 115A to be applicable, there should be an agreement with the assessee and the central government. The date of agreement may be before 2003 or after 2003. Are you with me? Say there is no PE or the services are not connected with PE, but there is agreement. Then the royalty and FTS will be taxable according to section 115A, not 44DA. Are you with me? Are you all listening? If there is no agreement, then 115A is also not applicable. And what is 115A? Very simple. Tax that 20% without claiming any expenses at all. It's a gross taxation. What is gross taxation? Whatever royalty and FTS that you are getting, tax it at 20% on a gross basis. Don't apply any other flat rates or slab rates. Gross amount will be subjected to 20%. That's what the department say. 20% plus cess plus surcharge, if any. Are you with me? So listen. If an income, that is royalty or FTS, is not taxable under 44DA, but there is an agreement with central government or there is an agreement with Indian company which is approved by the CG, then you have to tax it under 115A. 115A is very simple. Apply 20% on the gross income. There is no point of claiming any expenses. Are you with me? Now there can be a situation where there is no agreement. Yes or no? Say there is no agreement, but a non-resident receives some royalty. Say for example, the non-resident is a book author. He got some royalty from India. Are you with me? For publishing book and all, you don't require a central government approval. Are you all here? In such case, what to do? Very simple. If not taxable under 44DA and 115A, then you tell me what to do. Tax that normal rate as normal income after claiming all the deductible expenses. You consider it as a normal income. You claim all the normal expenses. You compute it as a normal total income, compute it as a part of the normal total income. Then you apply the slab rates. Nothing. Are you with me? In examination, you can expect any permutation and combination. In examination, you can expect any permutation and combination because they have tested this multiple times. Are you all here? So 44DA, 115A, normal provision. 44DA comes into the picture, you have to satisfy three conditions. 115A, for coming into the picture, one condition, that agreement condition. If there is no agreement, nothing, consider it as a normal income and tax it accordingly. That's what the department says. Are you all here? Super. Now friends, there is one note is there. What is that? Under section 44DA, such non-resident is required to maintain books of accounts under 44AA and carry out tax audit. 44DA mandates maintenance of books of accounts and carrying out tax audit. You must maintain books of account and you must carry out tax audit. This is what 44DA states about. Are you with me? So these are the things that you should learn in 44DA, comparatively easy section. This is nothing. If you understood, if you are understanding NR taxation is actually nothing. If you are trying to buy hard NR taxation, then NR taxation will definitely kill you. That is for sure. Are you with me? So friends, listen, the provision that we have learned right now was 44DA. Basically, it's an administrative section. Why I called it as an administrative section? It's not for, it's not any presumptive provision. It does not provide for any flat rates. It only says a restriction while computing the total income. Are you all here? Let's solve the question based on 44 DA. So straight away, please take question number 8. Take question number 8 and give me the answer. And as you can see, RTP May 21, RTP 2019, May 2019, RTP May 23, and it's a past exam question as well. Okay, thrice it has been tested in RTPs, and this is a past exam question as well. So just go through this question number 8 and give me the answer. So friends, let's solve the answer together. Question number 8. Let's understand what are they saying as a part of question number 8. Xylo Incorporated, a US company, received income by way of fees for technical services of 2 crore from Alpha Limited, an Indian company, in pursuance of an agreement between Alpha and Xylo. So one thing is there, agreement is there. Okay, Xylo is basically a US company, received an income of fees for technical services of 2 crore from an Indian company, Alpha, and in pursuance of an agreement between Alpha and Xylo entered into in the year 2012. So agreement is there with an Indian company, and there is CG approval, plus the agreement date is after 31st March 2003. Now, then, which is approved by the central government. Expenses incurred for earning such income is 8 lakh. Examine the taxability of the above sum in the hands of Xylo as per the provisions of Income Tax Act 1961 and the requirement if any to file return of income. What is this? I'll tell you later. Okay. Assuming that Xylo does not have a permanent establishment in India, they have agreement, but they don't have PE. So what should be the answer? 44 DA not applicable. Why? Since there is no permanent establishment, you don't need to think about 44 DA. Then the one section that will be applicable will be 115A. Yes or no? So the section that will be applicable will be 115A. So according to 115A, we need to compute the answer. So how much is the total income, friends? It is 2 crore. And can you claim expenses as a deduction? The answer is no. You cannot claim any expenses as a deduction. And hence, you need to tax this 2 crore under section 115A at what rate? 20% basic tax on gross basis. Plus, they are a foreign company. Yes or no? There will be applicable surcharge. And how much will be the surcharge? Surcharge will be at 2%, not 12, 2%. Surcharge will be at 2% for foreign company if their total income is more than 1 crore. Then, plus 4% cess on 2 crore. This should be your answer. They are talking, they are telling us to examine the taxability. What do you mean by examine taxability? It's a theory question. Under which section it will come? What should be the rate? You don't have to compute the final tax rate, but still, it's easy to compute the final tax rate. Apply 20 plus, surcharge plus. Are you with me? 115A. Maybe that portion will be carrying 1 mark. That's it. Not more than that. Second portion, what they are saying is, if Xylo Incorporate have a permanent establishment in India and the contract or agreement with Alpha for rendering technical services is effectively connected with permanent establishment in India, examine the taxability based on the following details provided. So there is a PE and this, this contract and the other things are effectively connected with the PE, then how do you compute the answer? Let's see. So if there is a permanent establishment and everything is connected with that permanent establishment, then you need to compute income in accordance with section 44 DA. Yes or no? Because already we know that there is an agreement. Plus, whereas the agreement is after 31st March 2003. Plus there is PE. Plus that the services are effectively connected with the PE. Then how do you compute? Under 44 DA. Now let's take FTS. How much is the fees for technical services? 2 crore. Now, expenses for earning such income. Can you claim it as a deduction? Yes, expenses for earning such income means it's an exclusive expenditure. 8 lakhs can be allowed as deduction. So effectively there will be how much? 1 crore 92 lakh, right? Then there are other FTS also. FTS for technical services received from other Indian companies in pursuance of approved agreement entered into between 2005 to 2010. They have signed different agreements from 2005 to 2010 with different Indian companies. Based on that agreements, they received another 4 crore as what? FTS. That also will be taxable under 44 DA. Are you with me? So that FTS is how much? 4 crore. Is there any expenses? Yes. How much is the expenses? 15 lakh. Claim that expenses, how much will be the effective income? 3 crore 85 lakhs. Now, you add these two, how much will be the net FTS effectively? Can you tell me the total? Yes, tell me how much is the total? 5 crore? 5 crore? 77 lakhs. 5 crore 77 lakhs. Now you tell me how much is the there are other things also. Number one, expenditure not wholly and exclusively incurred for the business of such PE, not included in 2 or 4 above. These are not exclusive expenditure. Hence, you cannot claim it as a deduction. Only exclusive expenditures can be claimed as a deduction. Since it is not an exclusive expenditure, you cannot claim it as deduction. Gone. Next one. Amount paid by PE to the head office, not being in the nature of expenditure of actual expense. It's not a reimbursement of actual expense. That is also not deductible. So your answer should be 5 crore 77 lakh. This Silo Incorporate is a US company, that means a foreign company. So it will be taxed according to the rate applicable for foreign company. That's it. What are the other requirements, if any, under Income Tax Act 1961 in this case? One more thing is there. In the first question, they are also asking us to check the applicability of filing return. Yes or no? Say they are saying examine the taxability of the above sum in the hands of Xylo as per the provisions of Income Tax Act 1961, and the requirement, if any, to file return, assuming that Xylo does not have any permanent establishment in India. So you need to check the applicability of filing return. You tell me whether return is required to be filed. The answer is, and when we study 115A, you will understand. Under 115A, there is a relaxation. If you only have this royalty and FTS plus TDS has been correctly deducted, then those persons are not required to file return in India. This we will study under section 115A. We haven't covered 115A in full. Are you with me? So when we discuss 115A, I will give you a further explanation on this point. For the time being, since assessee have only FTS income, and we are assuming that TDS have been correctly deducted. Obviously, TDS have to be deducted. Assessee is not required to file any return in India. That foreign company is absolved from filing return because they have paid all the taxes, that too by way of TDS. Let's not trouble them with return of income headache. You don't have to file your return of income, it has been relaxed. Are you with me? But if that foreign company does have any other income, then they must file return of income. Since they only have income under 115A plus TDS has been deducted, then they are not supposed to file any return. We will have a detailed discussion over this point later when we discuss 115A. Are you all here? Is this much clear? It's all about 115A as well as 44DA. It's not about 115A, 44DA. 115A, we have a separate chart to study. A very small section. Okay, this is the small section 115A. These all are 115A. Lot of conditions, lot of items are there that we will cover later. So we have just completed 44DA and I hope that provision is clear for you. We are moving on with the next provision, that is section 44C. Let's understand what is this 44C, that is deduction of head office expenditure in the case of non-residents. Okay friends, let's understand what is this 44C right now. So please listen. What are they saying in the 44C? Listen, deduction of head office expenditure in the case of non-residents. What are they saying? See, imagine a case, okay, imagine a situation where there is a head office, say it is in, say, Dubai, where IT rate is 0, and they have a branch. They have a branch in India. Say the IT rate 35%, because it is a branch of a foreign company. Now listen, say this is the situation. Say this particular company, this is a sports shop, okay, they run sports apparel, they sell sports apparels like boots, canvases, jerseys, trousers, etc. and sports equipments, etc. Say they brought CR7 for an advertisement, Cristiano Ronaldo for an advertisement to increase their global sales. They thought of bringing in CR7 and they paid 100 crores to CR7. 100 crores to CR7. I don't know whether CR7 will come for 100 crores or not. That is another debatable question. Since it is an example, I can say anything. Okay, say CR7 Cristiano Ronaldo came for what value? 100 crores. They paid 100 crores. Once Cristiano Ronaldo is your brand ambassador, your sales over the globe will go up because he is a global icon. Yes or no? Once he comes in and does an advertisement, then your overall sales will be high. So what you will do? This will be considered as a general overhead. You will bifurcate a portion to Indian branch and you will bifurcate a portion to the head office as well. Are you with me? So what you are doing is, you have bifurcated 70% of this expenses to India. Say 7 crore, not 7 crore, 70 crore you have bifurcated as an overhead to India. Only 30 crores you have shown as your expenses in Dubai. What might be the reason? Because Dubai doesn't charge any income tax. In India, you have 30% income tax. If you bifurcate majority of the expenses to the Indian branch, then we can save that tax. Anyways, we have incurred 100 crores as expenditure. Now, if we bifurcate more expenses to the taxable Indian branch, it is like we can save a lot of tax in India. Yes or no? This was there. This was there. So, what department thought of introducing section 44C? And what they are saying is, if you are an NR having different branches or having a foreign head office, then your Indian branch claims this general overhead as a deduction. We are not saying that you are not supposed to claim any general overhead as deduction. That would be cruel. Rather, we say we are putting a ceiling limit. We are putting a ceiling limit for you to claim the general overheads of your head office as a deduction for your branch. So, we are limiting the overhead expenditure that a branch of India can claim. Are you with me? That is what section 44C talks about. And let's understand what is 44C in detail. Head office expenditure means executive and general administration expenditure incurred outside India. So what department say is, deduction shall be as follows. If you are an Indian branch claiming a portion of your head office general overhead as a deduction, then you must compute that expenditure subjected to ceiling limit mentioned under section 44C. What are the ceiling limits? Either 5% of your adjusted total income or actual head office expenditure bifurcated, whichever is lower. Either your actual bifurcated head office expenditure or 5% of what? Adjusted total income. Now the question is, what is this adjusted total income? Listen, you cannot charge entire head office expenditure as a deduction. Either 5% of adjusted total income or actual head office expenditure, whichever is lower, only can be claimed as a deduction. Now the question is, what is this 5% of adjusted total income? What is this adjusted total income? For that, there is a computation sheet. Adjusted total income means what? Adjusted total income means you take your normal total income. You take your normal total income, then add back the following. Or rather we can say, you compute the total income without adjusting the following. Both are right. Yes or no? Either you compute the normal total income then add back the following, or you compute the total income without adjusting the following. That total income is said to be the adjusted total income. Which one are the following items? First of all, head office expenditure, 44C. You are not supposed to claim any head office expenditure while computing the total income. Number 2, unabsorbed depreciation. What is unabsorbed depreciation? Last year's depreciation you are not supposed to charge. Current year depreciation you can charge. Unabsorbed depreciation brought forward you are not supposed to adjust. Second one, third one. First proviso to section 36 subsection 1 clause number 9. Hope you remember. Capital expenditure on family planning. If you are incurring any capital expenditure for family planning, we have to divide that into two. Capital as well as revenue. Capital is allowed as a reduction in 5 equal annual installments. That also you are not supposed to adjust. You are not supposed to adjust that also. Then, next one. Any loss carry forward under 72. That is a normal business loss. 73. Speculation business loss. 74. Loss from the head, capital gains. 74A. Loss from owning and maintaining race courses. If you have these losses and there is a brought forward of these losses, you are not supposed to adjust these losses with your current year total income. Before adjusting these losses, whatever profit you have, that is said to be the adjusted total income. And finally, chapter 6A deductions. You are not supposed to adjust chapter 6A deductions as well. Or rather we can say, with the normal total income, you add back these items so that you will get what? Adjusted total income. Both are right. Both are same. Yes or no? With the normal total income, you add back these items, you will get the adjusted total income. On that adjusted total income, you apply how much? 5%. That is your limit number 1. Or you take your actual bifurcated head office expenditure and you compare whichever is lower shall be your what? Head office expenditure allowed as a reduction for the branch. Are you with me? So that is what they are saying. Then let me ask you one simple doubt. What if current year I am incurring a loss? Current year I don't have any total income. Say it is a loss. Then what to do? Then department say, in case of loss, consider 5% of the average adjusted total income instead of adjusted total income. What is that? Instead of current year adjusted total income, you take average of last 3 years adjusted total income. Average adjusted total income means average of adjusted total income of last 3 AY immediately preceding the relevant AY. You take the past 3 PY's average adjusted total income. You take the adjusted total income of, compute the adjusted total income of past 3. Take the average. To the company, it is only the third year. Then take last 2's average. It is only the second year. Then you take the last year. That's what they are saying. However, where total income of the assessee is accessible only for last 2 or 1, then the average of last 2 or 1 shall be considered. Are you with me? Are you all here? So pretty simple point. It is actually a ceiling limit for the head office expenditure that you can claim. That is all about 44C, and I hope it is clear. Let's solve a question in relation to 44C as well. So please take question number 3, friends. Please take question number 3 and give me the answer. It's a pretty simple question, okay? Let's solve it together, friends. Mr. Q, the net result of question number 3 it is. The net result of business carried on by a branch of a foreign company in India for the year ended 31st March 2025 was 100 lakhs loss. So the net result, okay. Of the branches, right now it is 100 lakhs loss. Now, what are they saying in the question? After charge of head office expenses of 200 lakhs allocated to the branch. So they've already charged head office expenditure, and that head office expenditure is how much? 200 lakhs. So you tell me, when you add back this 200 lakhs to the loss, what will happen? You will end up in net profit. That is 100 lakhs. Yes or no? Since the question does not have any other information, we are assuming that this net profit is the adjusted total income. Now, Explain with reasons the income to be declared by the branch in the return for AY 25-26. How much is the income to be declared in the return of branch? Very simple. You tell me either 5% of 100 lakhs or actual 100 lakhs, whichever is lower should be your head office expenditure. Are you with me? 5% of 100 lakhs is only 5 lakhs or 100 lakhs, whichever is lower means 5 lakhs is the maximum deduction for head office expenditure accordance with 44C. Oh, head office expenditure bifurcated is 200, right? Yeah. It is 200 lakhs. So either actual head office expenditure bifurcated, that is the 200 lakhs, or 100 lakh into 5%, whichever is lower shall be your ceiling limit under 44C. So it is maximum 5 lakhs only. Now you tell me, if you adjust that, what should be the total income in the return? 95 lakhs. That should be the total income as per the return of income of that particular branch. And that is the final answer to the question, and I hope it is clear. Is that okay? It's the easiest of the question that I can give. I can give you one more question, which is a past exam question in relation to 44C. So please take your question number 11. It's November 2020 6 marks question. Question number 11. Go through question number 11 and give me the answer. So we will solve that question also together, friends. Simple question it is. Listen, that is question number 11. So what are they saying? Net result carried on by the branch of a foreign company in India for the financial year ended 31st March 2025 was a profit of 20 lakh after charge of following expenses. Compute the income to be declared by the branch in its return for assessment year 25-26. So the net result is given, that too after charge of the following items. So number one, or the last item, if you check, you can see they have already adjusted the head office expenses. So first job is to compute the adjusted total income, then compute the ceiling limit, then you compute the total income to be declared in the return. If you do these three, you will get 6 marks. So let's understand, starting with the computation of adjusted total income. So we'll write computation of adjusted total income. So for computing adjusted total income, what is the reported profit? How much is the reported amount? It is 20 lakhs. Reported amount in the question is 20 lakhs. Reported amount in the question is 20 lakhs. Now, depreciation for the current financial year 15 lakh. That is allowable. No problem. That is current year depreciation. Unabsorbed depreciation of the previous financial year 17. That is not possible. Unabsorbed depreciation of last year you have to adjust, that is 17 lakh. Then capital expenditure incurred for promoting family planning amongst employees 7 lakh. That 7 lakh is the 1/5 of the total expenditure incurred on promotion of family planning. So what to do? Add back that 7 lakh. So that 1/5 of capital portion of family planning amount is 7 lakh. Then what is next? Expenditure incurred for scientific research. How much is that? 11 lakh. What to do? Nothing. Scientific research expenses are definitely allowable. You don't need to add back while computing adjusted total income. Business loss brought forward for assessment year 24-25. What to do? Add back. It is 72 basically. Brought forward business loss. You need to add back. How much is the amount? 25 lakhs. Then deductions, chapter 6A. What do you need to do? Add back. That is how much? 20 lakhs. Then what is the next one? Head office expenditure. Obviously, you need to add back. That is 125 lakhs. Now, can you tell me how much is the adjusted total income? Adjusted total income after adjusting everything shall be 214 lakhs. Yes or no? Now we will compute the ceiling limit. Ceiling limit shall be either 214 lakh into 5% or actual head office expenditure of 125 lakhs. Whichever is lower. How much is 5% of 214? 10.70 is the 5% or 1 crore 25 lakh, whichever is lower. So you tell me which is lower. 10.70. So 10.70 should be the maximum amount that you can claim as head office expenditure. Now you need to compute the total income that should be reported by the branch in their return. What should be the total income? You take the reported profit. Reported profit. How much is the reported profit? 20 lakh. In that 20 lakh, the only problem is head office expenditure. So you need to add back that entire head office expenditure, that is 1 crore 25 lakhs. If you add back that 1 crore 25 lakhs, how much will be the amount after this? That is 1 crore 45 lakhs. From that you can claim, accordance with 44C, maximum deduction shall be 10 lakh 70,000. So tell me how much is netting of 10 lakh 70, how much will be the total income to be reported in your return of income? 1 crore 34 lakh 30,000 should be the total income that have to be reported in your return of income, and I hope it is clear. This is the total income as per return of income. Okay, this is how you have to compute the answer. I hope it is clear. See, listen friends, listen. This 20, how do you get this 20? If you go to the question, after charge of all the expenses, the profit is 20. So all the expenses you have already adjusted. That's why you got 20. In this 20, the only problematic expenditure is what? Head office expenditure 125. For that, to check whether it is within ceiling or not, we computed adjusted total income. Adjusted total income does not have any other purpose to serve. Only for the purpose of checking that ceiling limit, we want adjusted total income. Okay. So that towards the end, we took that 20 and add back that 125 and only claim that 10.70, which is the allowable expenditure. The rest will be the income that should be shown in their return of income. Are you with me? There is no point of any confusion. When you read the question, make sure that you have spent adequate time on reading, because in examination that is very important. Don't think that I can pick the figures and write the answer. No. Maybe in exam they will say the reverse. Maybe in the next exam they will say the reverse. So don't pick the figures. Even if it is a question that you have solved, certain question will be there with the exact same figures. But make sure that you have read the question in full. Out of excitement, don't jump to the figures and pick the figures and write the answer. You must carefully read the question and make sure that, yeah, this is the same question. Are you with me? So always practice this. You need to practice this, okay? See, don't think like this. Now I'll pick the figures from the question and I will solve. In exam, I'll read the question in detail. Nothing will happen. Whatever you do now, the same thing you will follow in exam also. If you carefully, patiently read the question and solve it, then in exam also you will do the same. Because already in exam our stress level is high. In that stress level, you will not get any time to think anything else. So you have to make sure that you are spending adequate time on reading and understanding the question.